Hello, friends. Welcome to this special episode. And we are going to discuss the importance of staying in the market in this episode. And essentially, if you look at the long term CAGR of Nifty 50, as this chart shows, this chart spans from 1995 till the current. And you can see that almost over 29 years, the CAGR delivered is 11.75%. So, first of all, before even going into the actual topic for the day, those who are not investing can just simply see that despite whatever hiccups come on the way, you are making 11.75% annually. Of course, you can argue that this may not happen in the next 29 years, and that's a fair argument. It may be 13% also. So, from that point of view, the fact that you are afraid of the market, not able to invest in the market, you are sitting with 5.5% in the bank, that also taxable at your slab rate. So your effective returns there are less than 5% versus 11.75 here, tells you how much each year you are losing ground, and versus others, you are essentially slipping back. Uh, However much we may say that we should not compare ourselves to others, and we should not compare ourselves to others, but we have to compare our investment returns to inflation at least. If inflation is 5-6% and your investments are earning you 4.75, you are slipping every year. That comparison we will need to make. You may not compare with your neighbor, that's fine. But we need to stay ahead of inflation so that our purchasing power remains intact, so that we can enhance our lifestyle gradually as we invest and reap rewards. Anyhow, coming back to the topic, long term 11.75%. Yes, there were periods within this 29-year journey where maybe for 5 years there was zero returns, and maybe there were 5 years where you had fantastic returns. So, over a 29-year period, that is the average that you got. Now, total market days in this roughly 29-year period were about 7,133. Going from September 95 till July 2024. Keep this number in mind because this is going to make we're going to reference to this number in terms of the size of the number very soon. Now, what I'm going to show you is going to blow your mind. It blew my mind also when Parikshit in my research team gave me these numbers. This was mind-boggling for me, and I think it is going to be mind-boggling for you as well. What if we removed the 50 best performing days from these 7,133 days? We had 7,133 days, and let's assume we remove the 50 best performing days out of this and just take the 7,083 days for the study. Can you guess that number? Where will the CAGR, which is 11.75%, go down to if we remove the top 50 best performing days? My guess was it will go down to about 9%. That was my guess, but I was so wrong. The CAGR drops to 0.75%. I can bet most of you also were completely wrong in in gauging what would have been the impact of just taking out 50 days from the 7,133 days. It is still unbelievable. Less than 1% of the days taken out, but most of the returns are gone. Virtually the entire returns have been wiped out, right? Matter of just 50 days. So 0.7% of all sessions in this 29-year period actually have delivered all the returns. And this distribution probably will not change very much in the next 29 years also. So if you miss those top 1% or 0.7% days in the market, you have missed the entire returns cycle. That is the beauty of having in being invested and having your investments play in the market while the market is on, and not going in and out from the market. So Let's now dive in further. Let's say, what if we just removed the 10 best performing days? Let's not remove 50 days, just 10. I mean, 10 over 29 period is nothing, right? I mean, you go for a vacation. Sometimes people say, I'll liquidate my portfolio. I'm going to Manali for 10 days. I'll come back and I'll reinvest. There are people like that also who don't want to take 10 days of, market risk while they are relaxing in their hotel in a hill station. What happens if you remove the 10 best performing days? CAGR drops to 8.45%. So your overall final capital reduces by a whopping 58% if you just missed the best 10 days. Okay. So now further, let's do a study on 10, 20, 30, 40, and 50 days, same time period. So CAGR of 11.7%, starting capital 1 lakh. In 29 years, it became 24 lakh 57,000. Absolute gains of 2,358%. Missed number of days is 0. Now, if we miss top 10 days, CAGR drops to 8.45. Your end capital is from 1 lakh is now goes only till 1035. Absolute gains of 936%. Reduction in final capital is 58% just by missing top 10 days. You miss top 20 days, CAGR drops to 6%. Final capital is only 5.5 lakhs. Reduction in capital is 77% by just missing top 20 days. Top 30 days, CAGR drops to 4%, less than your FD amount. Final capital, 1 lakh invested, reaches only 3 lakhs 24,000 in 29 years, just missing top 10 days. Let's say you take one holiday every year, and that holiday, by whatever coincidence, is the top performing day of that year. You've lost all the gains. You are at 4%. Absolute gains up to 25% over 29 years, nothing. 87% loss or reduction in final capital. Top 40 days, CAGR drops to 2.3%. 1 lakh goes to only 1.9 lakhs in 29 years. 97% is the absolute gain, 92% is the reduction in capital. And top 50 days, as I mentioned, CAGR drops to only 0.75%. 1 lakh becomes 1 lakh 24,000. 24% is the absolute gain, and reduction on capital is 95%. Just a few days every year, or maybe once every few years, makes all the difference in returns for most people. This shocked me, and I hope it will shock some of you as well. Now let's look at the distribution of the top 50 days. So where were these top 50 days in the last 29 years? We had 8 days in 96 and 97. We had 11 days in 99 and 2000. We had 19 days in 2008 and 2009. And we had 3 days in 2020 post-COVID rallies here. So what have you noticed? Most of these 50 days are coming in periods where there was extreme volatility, markets cracked, and then markets raced back up again. This is the yearly distribution. You can see 96, 97, we had 4 each. You had 99, 7 days. You had 2008. You had 15 days in 2008. Now remember, 2008 was that year where you also had the maximum fall. So January 2008, the market started falling, and by end of 2008, Nifty was down somewhere close to 50%. In the interim, it was down even 71%. So within that fall year, 15 of those top 50 days actually happened, right? 2009, the year of recovery after 2008, 4 sessions. 19, 1 session. 2020, 3 sessions. 2021, 1 session. No days in the post COVID period. 41 of these top 50 days happened during post crash rallies. 2008-9 here, and here. And we all know, the usual story, what happens to most investors. You may be savvy investor, but most people are not as savvy as you. They will enter at the tops, and of course, nobody knows that a top is there. But that FOMO that comes around, when your money is sitting in the bank and everybody at the party is saying, I made 50% last year, I made 100% last year, my so and so stock has gone 4x, so and so stock has gone 8x. You feel stupid with your money sitting in the bank, and you say, now I want to sell my house and put everything on the market. That's how FOMO actually really works. That I've missed out the rally of my life, and now I can't stay out. And that's where tops get made, because irrational exuberance peaks at those tops, and then some sort of downtrend will come around. So this vicious loss making trap: enter at the top, exit at the bottom. And I incidentally, I have been in the markets also now for 29 years. Not that I've timed this data according to this, but I entered the markets in 1995, and I've seen thousands of folks make that same mistake year after year after year, enter at the tops. I'm saying I've done enough studies to even show you that entering at the top is not so bad, as long as you don't exit at the bottom. You enter at the top. If you entered at the top in 2008, you are still making a lot of money. You may not be making as much money as somebody who entered at the bottom, but you still are making a lot of money. And if you gradually brought in your money, that first entry at the top would not have made any difference at all. But what most people do, they will enter at the top, and when we get a bear market, unfortunately, we haven't got a bear market in a long time now. Uh, Market keep falling. 6 months, 1 year, 1.5 years, people get fed up. They say this is a bad investment. This is a wrong, line of investing. I was good with real estate. I was good with gold. I was good with investing in my own business. This stock market is just for casino players. Let me get out of here. When enough mass of those people decide in a group like fashion that okay, we're getting out, that is when the market actually makes bottom. See, if you have to understand why make market makes tops and why market makes bottoms. Market is like an auction mechanism. So as long as there's buyers who are bidding up, bidding up, bidding up, bidding up, sellers are willing to sell. As soon as the buying demand collapses, or the liquidity or the demand finishes, then the sellers get worried that they won't get any buyers now. Then they start to sell down, and then the top is made. The reverse happens at the market bottoms. Everybody's selling, 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 selling. The buyers are taking a step back. Okay, I can get it at 100. Okay, I'm getting at 90. Okay, I'm getting at 80. Now suddenly the next day they find that there are no sellers at 80. Now sellers want 90. So the buyer says, okay, I'll move at 90. Seller says, no, I want 100 now. Price moves to 100. So it's a dynamic that plays between buyers and sellers. It is the confidence of these players which causes them to go from one extreme to the other extreme. And if you will try to time it, that I will get out here and I will get in here, very, very few people will be able to be successful consistently. You may get it right once, you may get it right twice, but this dynamic keeps playing several times in a year, and it's very difficult to really get it right all the time. So you are buying in at the tops. These may be interim tops, but then there are bottoms where you may panic and sell out, or there is a huge crash like COVID where a lot of folks will just get out. And you know, easier to say in hindsight, but when this was happening, I had no idea that the markets will do what it did next, right? Like this. I was thinking market in COVID was crashing. Of course, we didn't liquidate, but we were, sitting with all our profits gone and maybe some losses also. And I was thinking markets will go sideways for at least a couple of years. And then we will come out of this huge global crisis that has encompassed us. Supply cycles have been broken down. There is no money with anybody. All businesses are reeling with all kinds of issues. Nobody could have imagined that these kind of this kind of rally would come around with those special days as well thrown in, the big top 50 days thrown in here. And then again, once market recovered, then everybody forgot about COVID, and then again, at each top that FOMO would come, and then you would set out at the bottoms. So that cycle will just keep continuing. This is human psychology. This will never change. It has not changed in the last 200 years. Nothing is going to happen to our brains to change it in the next 200 years also. So come artificial intelligence, come algorithmic trading, come whatever happens, human mind is not going to change because we are full of emotions. And as soon as we let emotions get the better of us, these actions will result, entering at the tops, exiting at the bottoms. So the key to a successful investment journey, you all know it, but I'll still repeat it. Embrace and stay calm in a bear market. We will get a bear market. We will get some thrashing sooner or later. I'm recording this on the budget day, so I don't know what will be the markets by evening today. But whatever it may be, we've gone through COVID, we've gone through 2008, we've gone through 2000 .com crash, and we've come out winning after that. You just need to stay calm and accept that falling is a part of the game. See the bear market as a golden opportunity to sip in rupee cost averaging. If you're gradually bringing in your money, it's actually good that in your initial years you get a downswing. If you don't get a downswing, you're buying high at a high rate. Uh, when you have a downswing, a big downswing like COVID, for instance, you get a good dollar cost averaging opportunity. And most importantly, assess if the strategy that you are following is capable of handling a bear market, of handling a situation where some of the stocks never come back, some sectors don't come back for years together. So your strategy needs to be a self-healing strategy, which is going to self-correct. Regardless of what happens in the market, the strategy will recognize what is winning now and what is not winning now. And I'll have to let go of stocks that are not winning. I have to get into stocks that are winning now. That strategy is the key to a successful investing journey. And you don't have to, get uh, emotionally involved that, oh, what should I do? My portfolio is down 40% and this and that. As long as you stay with your strategy, you will come out winning in a very, very big way. And you lose those 50 days, 40 days, 30 days, 20 days, 10 days, and you've lost it all. In numerous number of people have overconfidence that I know that I can get out now, market will be lower, I will get in there. And what actually happens? They buy it once the market has reached the pinnacle again. Because when it's human psychology, you have to understand this. Stock is at 50 rupees, and let's say you want to buy that stock. Now stock is at 40. You have the confidence now that the stock is dropping and it will go to 25. Then it drops to 30. You're waiting at 25. Now from 30, it suddenly goes to 40. That 30 has anchored in your mind now that the stock last week was 30. How can I pay 33% more now at 40 rupees? Then next week it goes to 50. Now you are saying 30 is 50 is too late now. Then it becomes 75. Then you're saying, it has more than doubled. I just lost it because of my greed of 5 rupees. I could have bought it at 30. But I know the stock is going to 200, so let me buy it at 100 now. And once you buy it at 100, maybe it comes down to the same cycle of going down to 30 again. So this is how our minds continuously will play with our focus and our intent. What you need to do is write down on a piece of paper, what is your plan? How will you buy stocks? What to buy, when to buy, how much to buy, and when to sell? This is the key to the market. If you can crack this key, you have cracked the markets. There is no looking back in what you can achieve in the markets. Let me know how you like this content. Do write in your comments. Your comments are extremely motivating a lot of times to to prepare more content and to figure out what is creating some impact in terms of your knowledge and your thinking. That is the whole intent, that we share some knowledge and whatever we can in terms of what we can share with weekend investors and otherwise, to make sure that you are also gradually going up that learning curve. And of course, you bless our channel also with your subscription. Thank you so much. I'll see you in next one. Bye.